Okay, now that we understand some symptoms related to inventory fraud, what we're going to do is actually go out there and look for them, right? We want to find out, is fraud going on? So, how do you look for analytical symptoms? Well, do analytical procedures, horizontal analysis, vertical analysis. Looking for something that's really strange in the numbers, right? Focus on a comparison, right? So you can use your non-financial performance measures, compare them to your financial performance measures. If they're a manufacturing firm and they make their inventory, what records does it show that the machines actually made, right? And does that compare with how much they say they have in the ending inventory? What went into the overhead, right? There should be records, right? So you can compare numbers, right? Look for strange changes. So if they have about the same sales, they should be creating about the same amount of inventory. And why would it change a lot? Why would cost of goods sold change a lot? If they have a lot more sales, they should have a lot more cost of goods sold, not a lot less, right? That would be strange. Sales increase, but cost of goods sold decrease. Could happen, not going to say it's fraud, but that would be an unusual relationship, and you should look at it. So all kinds of different things to look at. These are just two little ideas. Compare relationships to prior years, right? Other things in the finance. So you can do your horizontal, comparing to prior years. You can do your vertical, comparing especially revenues and cost of goods sold. Are they going in the same direction, right? Things like that. Compare financial statement amounts to your non-financial, right? If your cost of goods sold is increasing, or a decrease, I guess we're understating it, right? If your cost of goods sold is decreasing, does that make sense with what you understand about that company? Documentary systems. So documentary symptoms are in the books, right? So what am I looking for in my accounting? Well, you're searching for topside transactions by executives, right? Because inventory, so just like accounts receivable has subledgers, right? Every customer has their own subledger. Every inventory SKU item is going to have its own subledger, because you have to keep track of how many of this thing and how much did that thing cost, right? So again, topside transactions by executives, weird, what was it for, who posted it, when, where, why. So you can use your software to find weird journal entries, anything outside this time period, anything by this person, anything over this amount, right? Anything not through a subledger, right? Anything like that, anything at the end of the period, right? So all of these anomalies are going to appear and will be suspicious, and you can use your software to help you find those weird accounting entries. So the idea behind inventory internal controls is to keep it safe, keep it from being stolen, and to make sure the number value is correct. So you will be able to look where controls are weak. You will see, okay, here's an override. That's a fraud symptom, not just a weak control. But how often are they taking inventory, right? Because the main control for inventory is that physical count of the inventory. How often do they do it? Do they do it? How do they do it? Are they making sure things don't get counted twice? Like if they're not using some kind of inventory tagging system, how do you know they're not counting things twice? If they're not looking specifically for obsolete inventory, how do you know they're writing it off, right? So things like that, you just have to see what they're doing and see if it makes sense to you. Lifestyle, behavior, verbal. So going out there, asking questions, and seeing what it's like when they answer you. Do they seem truthful? Are they telling you the truth? Are they not being forthcoming? Ask them about inconsistencies, right? You say that inventory is worth these many millions, but I see from my analytical procedures that your inventory turnover has decreased. How do you know there's not obsolete items in there? And then see what they we know, right. So ask them questions and see what they're saying. See if it seems correct, because again, overstating inventory tends to happen in the saleability of the inventory and the value of the inventory. So looking for those. Who are these vendors, right? So asking them about that. Why did you add this vendor? And finally, as you're trying to find fraud in the inventory, look for tips and complaints. So directly speak to employees who handle inventory. Speak to vendors. Speak to customers, like if quality is dropped off. That's another way they commit inventory fraud. They say something is of one quality and it's really of a lower, so it's worth less, but they're saying it's worth the quality of the higher. Review those whistleblower records. If it's a public company, they have to have it. All right, so that's takes care of inventory fraud, which also takes care of the chapter because it was about revenue and inventory fraud. So now I just have a much better idea about that stuff.